You need to also think about if there is seasonality within the business where you generate significant amount of cash flow in the first half of the year. How do you use that cash flow from the business through loans coming out of the business and generate more wealth for yourself? And you don't need to just go out and buy properties, right? There are so many different strategies. Renovation, JV partnerships, quick flips. Your risk appetite needs to be slightly higher, but you can go in and come out of some of these deals quite quickly and generate an easy 10 to 15% return. So it comes down to understanding the tax implications, understanding what you can leverage in relation to the business cash flow and loans, and declaring income from a future planning perspective. You're listening to Helpmebuy Property Podcast, powered by Investor Partner Group. We help improve lifestyles by building scalable and sustainable generational wealth and passive income streams. We do this via our ecosystem that is a one-stop shop to all property investment needs, from evidence-based, data-driven buyers agency, industry-renowned portfolio reviews and property strategies, property development with and for clients, tax, SMSF, business structures advisory, and cash flow real estate. Everything we do is to help people achieve financial independence and not just basic financial freedom by using property as a tool and as a medium. Presently, we've launched Australian Property Academy, where we are training and teaching buyers agents, property advisors, property strategic partners, and secrets to finding investor-grade properties to astute investors. Connect now to experience it yourself, or drop in a line below at info@helpmebuy.com.au to get more information. Be kind and happy investing. Today's topic is, why do business owners fail as property investors? We'll discuss all the mistakes business owners make when investing into property and the borrowing tools that are available to business owners to maximize their borrowing capacities. So stay till the very end, and let's do drum roll to introduce Miss Cheryl. Cheryl, how are you today?
Hello, Mox. For a moment there, I thought you said boring tools. And yes, well, this is part 2 of our discussion around property investing and business owners and how to be able to leverage property investing when you're a business owner. But there are certain things that we'd like for our business owners to avoid doing, so that they set the mistakes. This is about sharing and being able to...
we're judging ourselves, right? Because, we have made those mistakes as business owners. So, this is us sharing our learnings basically, right?
And it's the mistakes, but also the things that the business owners are not aware of, So I think if we can highlight a few things, again, we'll put in the disclaimers, anything, speak to your accountant, your financial planner, do the right things. None of this is financial advice. We are just sharing our knowledge and our experience
100%.
here. All right. So what are some of the key areas to take note of?
I think the first one for me that basically comes right off the cab and very relevant to today's world or today's times is interest rates. Way too much focus on interest rate because people are like, oh, I'm paying too much interest, and how do I go around reducing interest rate, and instead of 7.5%, why don't I pay 7%? And so naturally they are so used to controlling cash flow in their businesses and profit that they come in on the other side about property and they think about interest rate the first thing, and it's where they make a lot of mistakes, right? I always say this to people, that making decisions in interest rate in a point in time is always wrong, right? So when people are thinking about hindsight and 2% interest rates and buying properties at 3% yield, and I kept shouting from the top of the tower that, don't buy properties at 3% yield because they're not positive cash flow property, because you're making a decision in a point in time. It's the same thing on the other side, right? Now that the interest rates are sitting at 7%, everyone wants a property that yields at 9 or 10%, right? So again, you're thinking about it in a point in time, thinking about it from a long-term perspective. How does the interest rate plays its part? And how do you build a sustainable property portfolio that answers to all of these peaks and troughs when it comes to interest rates, right? Rather than thinking about it in a point. And look, as a business owner, unfortunately, because you're running a business, you are a risk from a bank's perspective. So yes, they will charge you a higher interest rate. And yes, in order to access some of these products, they will charge you a slightly higher risk premium when it comes to interest rate, but it's okay to pay that, right? Because ultimately that's the cost of you creating net wealth.
The benefit, and you've got to look at it that way, right? It's the cost of doing business, and it also means it's the cost of having some level of flexibility as well.
100%.
So we're going to be talking about some of the boring tools. So this focusing too much on interest rates. Another thing that I like to talk about tax planning here. We don't plan enough, and I say if you're failing, what's the saying? If you're failing to plan, you're planning to fail.
Yes.
So it's looking, and often as business owners, we sort of almost are like on a year by year basis, sort of like, oh, okay, great, we made a profit. Oh, yes, no, oh no, this year wasn't so good. It's sort of a little bit up and down sometimes, right? Unless you have the benefit of a business that's constantly growing. Generally, it's a bit like this, okay? It's a bit tops and bottoms. So important that you sit down as well with your tax advisor before the end of the financial year to be able to go, hey, let's do some tax planning. How much do I need to put into do I need to top up my super? What are the things I need to do and take into account for the next year? Because I'm going to be wanting to purchase properties and so on and so forth. So a really good tax planning session should be able to effectively allocate where your funds need to be the most tax effective.
Definitely.
And I said about being tax effective, not necessarily, it's not tax avoidance, it's being tax effective.
Yeah.
So there may be times where your advisor might say, hey, why don't you top up some of your super, and then you can purchase property
100%.
in your super.
And I think it comes down to, managing cash flows during the year as well, right? Having that conversation at the end of the cycle with the tax planning to plan for the next year. I think that's very, very important. And you need to also think about if there is seasonality within the business where you generate significant amount of cash flow in the first half of the year. How do you use that cash flow from the business through loans coming out of the business and generate more wealth for yourself? And you don't need to just go out and buy properties, right? There is so many different strategies: renovation, JV partnerships, quick flips. There is so much stuff that you can do where, yes, your risk appetite needs to be slightly higher, but you can go in and come out of some of these deals quite quickly and generate an easy 10 to 15% return. Yeah. If you manage it quite well and if you understand how to do it correctly, right? So it comes down to understanding the tax implications, understanding, what you can leverage in relation to the business cash flow and loans, and declaring income from a future planning perspective. I think in the last episode, we were talking about whatever you declare this year is going to be what the broker is going to use next year for your borrowing. So you need to have that plan right now as to, okay, if I had an amazing year and I'm going to declare X, Y, and Z to build my portfolio next year, I don't be stingy and not declare some of these things. And your bright bang golden words, it's not so much about tax avoidance, it's about tax planning and effective tax paying, because then the conversation is all about net wealth and, how much more do you make from an overall perspective.
My accountant, who hopefully is listening to this, will be very proud of me that I've used the word tax effectiveness and tax effective as opposed to tax avoidance. Right. And that whole point around one of the mistakes that we do, and we did touch on this very briefly in our previous episode, was around not paying yourself enough as well, not even paying yourself at all. So, how is that impacting your ability to service loans or ability to be able to, and Definitely. So you need to be able to sit down with your broker around that and your accountant to be able to go, right, well, what should I be paying myself? And so, even when you're looking at your business in general, often we do look at the profit margin, we look at the profit margin, is it healthy? But that needs to also reflect what typically your role would also pay that particular position. If you were someone else and you were employing someone for that role, how much will you pay that? It's not going to be $20,000. It's probably not even $50,000. It might be under $250,000. So do you pay yourself 250,000 or are there certain ways that you move towards more profit or whichever? And that's again a conversation that you need to be able to balance with your accountant.
100%.
Because you probably have, if you've got a mortgage or whatever, you need money in the bank to be able to pay for a $2 million property. There is a bit of a balancing act there, and don't try to figure it out yourself. Get clear on your personal finance and also your investment sort of finance as well.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book. It's easy to read. It has a lot of stories. It has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book. Expanding on that, look, typically people with big families, right? And I'll share one of these experiences with, my recent client. It's not just, and so people who are running the businesses only tend to think about themselves. Well, you have a wife and a parent, think about all of them, right? That is your servicing, right? You can build up their servicing typically together at the same time, right? And I'll share this story. One of the clients who came to me and he said, look, my borrowing is capped out, but I'm sitting on $1 million and I run a business. And I was like, well, so do you have a family? And he's like, oh yeah, my dad has moved here and he's got residency X, Y, and Z. And I was like, so build his servicing. And he's like, what does that even mean? And I was like, well, start paying him, right? Start paying him something. All you need is 3 months of credits, right? Think about it, right? From a bank's perspective, they don't need to see the full year. They don't need to see 10 years worth of his experience. And call him X, Y, and Z, whatever, right? CEO, name him the CFO or whatever you want to call him, right? Find him a position in the business, pay him 3 months of credit, and build his servicing and start borrowing against it, right? Ultimately, it's all about generational wealth, right? Still keeping it within the family, right? So you think about, multiple ways, it's not just about, and so that's what it comes down to, tax effectiveness, right? How do you go around paying each other enough that you're not exposing yourself to taxes, but you're building the servicing that can help you borrow in multiple different facets, right? So and
I've got images of granddad looking at zero going send invoice. Excellent. And if that's what it takes, if you are employing family or whichever, particularly people that are in retirement phase, take into account how that's going to impact their if they've got I was going to say the dole pension and things like that.
The
so
pension,
this is something again, if you've got the right sort of advisors, these are all holistic things you need to think about and sort of just be able to explore. Personally, I'm not a tax expert in any sense, and that's why I engage people who are, so that they can sort of be able to say, hey, these are the certain rules and regulations that are in place, which allows you to do, this. You can take advantage of this ability to do that. Yeah.
I think another mistakes, or should I say, problems that I see with business owners is because they are so used to generating quick ROIs in their business that they expect the same thing from the property, right? So they want quick money, they want quick ROIs, they want quick returns. And look, property is unfortunately not for quick ROIs, right? Even if you talk about developments, and it's such a shame and unfortunate, that business owners are the ones who get burned a lot because of this mentality. They'll get scammed into, one of these property developments, which is offering 25% return with monthly 3% return giving back to them. And unfortunately, they fall scam to some of these things because of that quick cash back coming back to them. And while they're trying to do the right thing using the cash flows from the business, unfortunately, it's the mentality that brings them down and takes them down, right?
Yeah. So what are some of the options for business owners to be able to borrow more, buy more? It's often the key thing that it's like, well, how do I ensure that I can keep buying more properties?
Yeah. Look, ultimately, when you're talking about options, right, the first and the foremost is speak to the right broker, the right planner, the right tax accountant, right? A lot of people think that they're the same people. Every mortgage broker is the same mortgage broker, and every tax accountant is the same tax accountant, and every property advisor is the same property advisor. And it's not the same. Like, it's not a gardener that you're going for. It's not a plumber that you're going for, right? They have their own niches. They have their own swim lanes. So you need to find a person that basically specializes in business owners and, these sort of income brackets, right?
Yeah.
And then they would be the one who would be really able to help you.
Yeah.
The first and the foremost is, and probably everyone knows about this, is the low doc loans and the no doc loans. Everyone knows about low doc loans, but there are also no doc loans.
Yeah.
And yes, you would pay a bit more premium towards the interest rate, and you have to pay a slightly higher interest rate. And yes, your LVRs might be a bit lower, and the banks would only give you 80% LVR. But it's a perfect opportunity to enter into the market, right? Low doc loans typically work with you providing, very little evidence, typically like BAS statements or projections for financials, etc. No doc loans are basically accountant's letter, and that's it. That's all you need. Your accountant to say, hey, the business is profitable, give them the loan. And some banks do actually provide that as well. So it's important you explore some of these options and opportunities without thinking about the interest rates and going in and investing in some of these things.
Yeah, and just reiterating, it's not about always getting the lowest interest rate. Often the lowest interest rate has probably the least amount of flexibility in what you are able to do. At the end of the day, particularly if it's an investment, there are tax deductions that you can make from your interest repayment
100%.
As well. So just keep in mind,
100%.
It's not always about the lowest rate. It's around the one that's going to give you the flexibility and ability to do what you need to do.
Definitely. The second thing when you think about the borrowing is typically salary credits. And I think we touched on this before. Majority of the times when the bank is looking for servicing or borrowing, they are looking for bank statements for 3 months worth or 6 months worth. These days, the banks are a bit more stingy, and so they'll ask for 6 months worth of bank statements and salary credits. And so basically that's what you want. That's what you need, right? So, build that profile in anticipation. Think about, okay, how do I need to bring someone into the business? Be it your wife, be it your kid turn 19 or 20, be it your trust, right? So there is various ways that you can build that servicing for you to acquire properties. You can build servicing within the companies as well. A lot of people don't know that. It's not just about people. It's also about companies. You can bring in a business and build a servicing of the business to basically provide, servicing to a particular debt as well. So there's various ways to provide those salary credits, those ways to basically borrow money from the bank.
And what do you think in terms of structure? Because, you've got companies, you've got trusts, you've got sole traders. From your experience, which is the most difficult to be able to access servicing?
Look, I mean, I've seen servicing happening through everything, but, usually the banks don't like trading entities. Banks love non-trading entities typically. And so trusts are usually the easiest way from bank's perspective. But the problem with the trust is that the trust on its own does not have the servicing, and so they'll always seek a personal guarantee. And so someone needs to stand behind the trust for the trust to service the loan. But, from a longevity perspective, non-trading trusts are the perfect way. Again, please don't constitute this as a tax advice. Go speak out to your tax accountant. But discretionary trust or family trust are perfect vehicles, or even unit trust to a certain extent are perfect vehicles from bank's perspective to provide loans and, build portfolios and generational wealth. It's easy to move trusts around as well. All you need to do is change the trustee or the trustee company at the top, and the ownership of the trust changes quite quickly as well. Companies can get a bit more messy, and the directorship of the trust, companies can get really, really messy as well. But I've seen companies getting lending as well, if the need be. The biggest difference between the company and the trust typically is that trust has access to the discount rules, where 50% discount rule is allowed for the trust, whereas the company don't go get those discounting rules. So it's important that you understand what are you trying to do with the property, and if it's a long-term hold, of course, companies don't make sense versus trust. But if you're doing a development project, typically both of them would be of an option. Again, speak to your accountant. How do you do the distribution? The company's distribution is a lot more difficult versus trust distribution. You can control it a lot better, a lot easier. You can have a trust with a bucket company beneath it and, have the benefits of the both worlds. And so there are various ways that you can use the structures to your advantage as a business owner to provide and create servicing for yourself.
Yeah. So again, sometimes this is a real sort of whirlwind of information where it's like, I don't know which is going to be the most suitable for me and my situation. It is going to change for everyone. So just sit down with your tax advisor, sit down with your advisor, and work out a plan forward, and make sure that you really understand the pros and the cons of if whatever structures that you're setting up a purchase in, weigh up the pros and cons. In any case, if you're going to be purchasing investments, just really avoid not buying it in your name. That's probably the only thing that I like to say.
100%.
And that's, again, not necessarily tax advice, but just from a personal experience perspective, there are better ways to purchase investments.
If we give people like a rule of thumb, typically if your business is higher cash flow but lower on profit, or you're declaring lower profit, which means that low doc is your friend, then you need to go down the path of low doc. But if you have decent cash flows and profits, then of course, full doc becomes an opportunity for you, and, you can use salary credits and, the trust, etc., to basically help you and support you. Yeah. Just don't operate as sole traders. Banks hate sole traders. There is some banks now who've brought in products for sole traders, or, what they call it is single person businesses. Like, it's not a proper business. It's just a one-man show. Although you are a plumbing company, but you are the only plumber in that company, for example, or you're a gardener and you have a lawnmower and you just basically go out there and do the lawn mowing. So that, single person business or sole traders is where banks' risk appetite basically changes quite significantly. And so make sure that you're not just operating as a sole trader under your own personal ABN, because that's not going to really help you. Having said that, if you have an ABN which is 24 months old, then typically the banks would consider some of these things, especially if you have GST opened up within your ABN. So if there is no GST, again, this comes back to tax saving, right? A lot of people don't, turn on GST because they're like, I want to keep myself below threshold of 75,000 and I don't want to pay GST, and I don't want to collect GST, and I'll make this money and pocket it into my pocket. And understand, if you don't collect GST, the bank looks at you as that this guy is a cheapie, and not cheap, and we don't want to give any loans to this person.
Are they carpenters? Is that what you mean?
No, not Chippy. Chippy makes a lot of money. I think Chippies are amazing people. I love Chippy.
You're digging a hole now. Keep going.
But typically think about it from that sort of perspective. Don't think quite narrow from that mindset. Make sure that you have a GST attached to a 24-month old ABN, and then you're basically heading out to the bank. But run the business like a business. Don't run a business like
a hobby.
Yeah, hobby. Yeah, exactly. Yeah. Actually, do the GST. I know it's a pain in the bottom to do your best and all of that, but it is going, in the long run, it is going to be a vehicle that's going to allow you to leverage and build your wealth a lot quicker if you've done the right way. 100%.
Yeah. So we've talked about, so, if you are going to be starting a business and get that ABN in, get that GST in, because it is going to take around that 2 years for the banks to actually acknowledge the income that comes out of it. In the meantime, like if someone has been operating in their business for 6 months or so, is it typically like the no doc loans that they can leverage, or is that still not enough time?
Yeah, no, typically, look, I mean, no doc loans are something that is not mainstream. And, it's only a handful of brokers that would really know about no doc loans. There is only a handful of lenders who basically operate in this space as well. But, the accountant becomes your best friend basically in those circumstances, You need to make sure that your accountant understands the business quite well, understands the add backs and all of these depreciations, etc. And the car that you think that you have it for your personal use and it's not for the business use, and all of these crazy stuff that you're doing within your own business. Make sure that your accountant is your best friend.
Yes,
and he can project the right picture of the business through the financials and the projections, and that would basically provide enough evidence from bank's perspective that this person is not a high risk person. One thing that I do want to say is that a lot of business owners are very reactive. They wait for the businesses to mature, and only in year 6 or year 8 or year 10 of their business, they really start thinking about property investing. They're like, now I'm running a $10 million business, or I'm running a $5 million business. Now I'm going to basically go out and invest into property. On a simpleton level, it makes a lot more sense. You want the business to mature and then basically take risks. But you don't want to basically wait till that level, because then you're letting the market grow quite exponentially if you're waiting 10 years. I spoke to a business owner just recently who is earning close to about $2.5 million in revenue a year, and he's been doing that. And so he's been doing roughly about $300,000 to $400,000 a year over the last sort of 10 years, and never bought a property, like not even a principal place of residence to live in. And I was like, well, that's so sad, right? Like, you've been making enough money for the last 10 years, but because you've been so focused into building your business, that you've never thought about investing into property and converting your cash flow for the business into, real assets. And so it's only like when now that you are feeling the FOMO and you're like, everyone else around me has so much wealth and I don't. Well, that's because you have not been investing typically, right? So, yeah.
And again, it's never too late. I think everyone's got their time. Like, if once you realize that, then put in the action steps to be able to achieve that, right? And I think, for a lot of people, they sort of look at businesses, I said, the ROI is so good, why would I invest in another asset? And it's not discounting the fact that business is a really great vehicle for that. It is, as we said in our first episode, it's that idea of diversification and risk mitigation as well.
Yeah, 100%. Any last words before we wrap up, Cheryl?
Oh, the last words, basically, if you haven't listened to our first episode and the second episode, as you can tell, we're really, really passionate about the fact of growing. Business is a fantastic vehicle. Business is a fantastic asset. It is, however, unpredictable, just like anything else. And just anything, whether you're working or you're in a business, like, look at other ways to diversify your income. Property is, as you know, it's Helpmebuy property. We're going to be talking about property. It is your fairly low risk and low touch vehicle, which can really complement your future long-term wealth plans as well. So, have a listen.
Thank you for the golden words.
I'd love to hear from people who are business owners and have grown their wealth outside of their businesses, what the experience has been. And for those of you who have businesses but haven't delved into the property realm, I'd love to understand why that's the case. What are the challenges? What are the things that are holding you back on it as well?
Definitely. And if you're a business owner and if you want to jump on a podcast and talk about your struggle with property and business, I think we would love to, have you on the podcast and have a bit of a fun banter as to, why business with this property. Yeah, shebang. That's it. Yeah.
A shebang.
Thank you for listening to us. Take care. Keep safe, keep smiling, keep investing, be kind. This is Cheryl and Moss checking out. Adios.
Yeah, ciao, bye.